In this video, we will get information about cash reserve ratio. So, without wasting time, let's start. The average daily balance that a bank is required to maintain with the Reserve Bank as a share of such percentage of its net demand and time liabilities that the Reserve Bank may notify from time to time in the Gazette of India. Banks can't lend money to corporates or individual borrowers, and banks can't use that money for investment purposes, so that cash reserve ratio remain in the current account and banks don't earn anything on that. In terms of section 42(1) of the RBI Act 1934, all scheduled banks are required to maintain with the Reserve Bank of India a cash reserve ratio of 4% of net demand and time liabilities. If RBI increases cash reserve ratio, the available amount with banks come down and RBI uses it to drain excess money from the banks and vice versa. Importance of cash reserve ratio. A cash reserve ratio is a prominent tool for RBI. It is used for controlling the liquidity and inflation, deflation in the country's economy. RBI reserves the right to modify the cash reserve ratio at any given time. Did you know that who decides cash reserve ratio in India? So the answer is the cash reserve ratio or cash reserve ratio in India is decided by the RBI's 6-member Monetary Policy Committee during the monetary policy reviews. The cash reserve ratio is among to many tools available to the RBI to manage liquidity and check inflation in the economy. Did you know that who maintains cash reserve ratio? So the answer is every scheduled bank, small finance bank and payments bank shall maintain a minimum cash reserve ratio of not less than 90% of the required cash reserve ratio on all days during the reporting fortnight, in such a manner that the average cash reserve ratio maintained daily shall not be less than the cash reserve ratio prescribed by the Reserve Bank. Do you know that how does cash reserve ratio control inflation? So the answer is cash reserve ratio helps in keeping inflation under control. If there is a threat of high inflation in the economy, RBI increases the cash reserve ratio. So banks need to keep more money in reserves, effectively reducing the amount of money that is available with the banks. This curbs the excess flow of money in the economy. Did you know that what happens if cash reserve ratio is reduced? So the answer is when cash reserve ratio is reduced, more funds are available to banks for deploying in other businesses because they need to keep favor amounts with RBI. This means that the banks would have more money to play, and this leads to a reduction of interest rates on loan provided by the banks, and it increases lendable resources. I hope you got all information related to cash reserve ratio. So like this video and subscribe our YouTube channel Commerce Index.